Hello and welcome to ETF.com's Generating Income series of webinars this week. This is 5 straight days of information and interviews about various pockets of the world of income-generating investments, from building multi-asset income portfolios, looking at dividends in new ways, share buybacks and shareholder yield, how to increase yield using traditional bond portfolios, and finally, on the final day, looking closely at the highest yielding ETFs that are available today. Today's presentation is building a multi-asset income portfolio with ETFs. This is a complimentary ETF.com webinar courtesy of Charlotte, North Carolina-based Horizon Investments. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, we wanted to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. And if you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these during the webcast, but if a fuller answer is needed or if we run out of time, the question will be answered later via email. We do capture all the questions, so do not hesitate to ask any. A copy of today's slide deck and any additional materials are available in the resource list widget that looks like a green folder at the bottom of your screen. Additionally, you can expand your slide area by clicking on the maximize icon at the top right of the slide area or by dragging the bottom right corner of the slide area. Now, if you have any technical difficulties, please click on the help widget. It has a question mark icon and covers common technical issues. Now, bear in mind that an on-demand version of this webcast will be available approximately a day after today's webcast, and it can be accessed using the same audience link that was sent to you earlier today. Joining me today are Josh Bartholomew, the Managing Director of RIA Sales at Horizon Investments, and also Kevin Blocker, who is a Senior Quantitative Strategist at the firm. Horizon, which runs ETF-only portfolios, now has more than $2 billion in assets under management. Now, Horizon Investments is the perfect advisor to launch into our inaugural Generating Income webinar series this week. You're not going to find a more astute group of students of the ETF space that the team of Horizon Investments has assembled. Moreover, this is a firm that is very much ready to think outside of the box. And as any fixed income investor knows these days, now is the time to think outside the box. Bond yields have been barely keeping pace with inflation, even if inflation remains below the Federal Reserve's target. And investors who have played defense since the market crash about 6 years ago in short-dated bonds have had their paltry yields buried by inflation. And on the other hand, investors keen on getting yield in the bond market have taken on duration risk in risk-free debt markets like treasuries, or they've taken on credit risk in corporate bonds, high yield or investment grade, or else otherwise in the emerging markets. All these choices have risks, as the bond markets have shown in the past few years, notably during the taper tantrum in the spring and summer of 2013. As if to add insult to injury, the prospect of interest rate increases from a floor of terribly low yields raises the possibility of capital losses. And now the Fed has indeed put its first rate hike in 9 years on the table, and that anxiety about capital losses is again in focus. So what are investors to do about it? First of all, my guests are going to describe the current environment, its challenges, and the fact that there is no free lunch in investing. Every decision has its advantages and its consequences. They also get into the solutions they're working on in client portfolios, notably the use of securities like MLPs, and not least using equities in a yield replacement manner. So let's get into it with Josh Bartholomew and Kevin Blocker of Horizon Investments. Josh, take it away.
Thanks, Ollie. Appreciate the opportunity, obviously, to kick off this series in generating income. My name is Josh Bartholomew with Horizon Investments. I'm the Managing Director of RIA Sales. You will have some information on how to contact Horizon Investments at the end of this slideshow. I would just tell you and encourage you to look at our website, www.horizoninvestments.com. All of the things that we discussed today have tools that are applicable on our website. So we encourage you to go there, but also I encourage you to reach out to us afterwards with any questions about our firm, what we do, our capabilities, and certainly in terms of creating income or in terms of our real spend strategy. Horizon Investments located here in Charlotte, North Carolina, as Ali mentioned before. This December will be 20 years in business in managing strategies that really stretch the life cycle of investments opportunities for clients. So from the gain, the risk mitigation or protect, and then also to the spend life cycle, we are pride ourselves, I think, in finding and innovating around solutions that are relevant for clients in each one of those stages of their investment life cycle. Allocation, global active allocation is very important to us. We're a global flexible ETF strategist. Certainly there are many out there that manage global active asset allocation strategies. We are one of them, and one that has been around, as I said, almost 20 years this December. And so asset allocation really is at the core of what we do as an ETF strategist in the space. That said, one of the things that keeps us up at night are really those that hopefully keep you up at night. How do we manage against catastrophic loss? And for our practices, how do we manage for clients that are in the distribution phase of their investment life cycle? Each one of these needs have different types of solutions that must be applied. And so at Horizon Investments, what we've done is tried to innovate around each one of these needs and provide solutions that are relevant for each one of these life cycles of the investment landscape. So with me today is my friend, my business partner, a principal of our firm, and a portfolio manager, been here since 2001 at Horizon Investments, Kevin Blocker. He's here today to focus specifically on what keeps us up at night in handling the distribution needs of clients, how to do it efficiently, and how to do it in a way that makes sense for the client, and most importantly, how to do it in a way that makes sense for your practice. So Kevin, I'll hand it over to you. Thanks for joining us.
Yeah, thanks Josh, thanks Ali, everybody, and thanks everybody for joining us. As Ali kind of mentioned, really we're here to talk about kind of the new class or what some of the future solutions might be for generating income. And C mentioned as well, I'm going to kind of lay out a little bit about what the current challenge is and why there's so much opportunity within the space. I'm going to highlight a little bit of the current strategies that have kind of been predominant. I'm going to highlight a little bit about some of the new ETFs and some of the things that are really being brought to market with the specifically with the MLPs and REITs, and potentially a little bit about some of the risks that go along with that. And then I'm really going to highlight again a more diversified strategy. Internally here we have what we call the real spend strategy, but I'm really going to talk more about just what happens when you have more of a balanced portfolio, which continues to include equities as you go into retirement, because the challenges that really are ahead of the retiree are very significant. So with that, I'm going to kind of move into the first section. Again, as Ali mentioned, if you have questions, of course, just type them in, and we'll get to those somewhere along the line here. But really kind of setting the foundation as far as we talk about here, the challenge and the opportunity. The real thing that everybody knows, or the real kind of challenge that's in front of us, is really the demographic shift. Really, it's all about the baby boomers, and it's at this point there are essentially 8,000 retirees on a daily basis. So we all know about the baby boomers. We all know what's ahead of them, but that really puts kind of a number on the number of those those retirees going forward. That creates a very specific opportunity for advisors who focus on the retiree, but it also creates a significant challenge. Along with some of this information that I'm showing now, which is it tells us more about the amount of savings that the average retiree has. So we can stop and look at this slide for a second, but the first time I saw it, I was kind of surprised because essentially what it highlights is that I'm going to be generous here. I'm going to say, let's say 20% of retirees have more than $250,000. So they obviously need some significant, they're going to need a significantly successful strategy as they go into retirement, because we're not really talking about the edge cases of individuals who have, let's say, $5 million and it can potentially just live off interest, especially if rates do rise a little bit. We're really talking about the meat of those baby boomers that really haven't done a great job, let's say, of saving liquid assets. They may have a home. A small number or a diminishing number may have a traditional pension that's supporting their income, but they're going to need to really rely potentially on a strategy going forward, and that's going to be, again, that's really where the beginning of this opportunity comes in. As these 8,000 individuals on a daily basis retire, the priorities, and as the advisors on the line know more than I do, really, their priorities really do change. They've saved a certain amount of money. It's no longer about accumulation and necessarily growing those assets. It really does come down to protecting the assets they have, and more importantly, really generating income throughout their retirement. And it shifts some of those risks, which we're going to talk about here in a minute, but it really focuses a little bit more on inflation, and it shifts the risk of longevity. As we all know, individuals really are living longer, and as longevity really does extend out, I think there's plenty of people that are retiring, let's say age 60 or 65, and if you ask them how long they plan to live, I don't think many of them would say, well, I only plan to live to 80, because that's what the actuarial tables say. I think they would plan to live more than 20 years, and I think one of the main challenges we're going to highlight here going forward is that a lot of the research that's been done into retirement solutions focuses on either a low amount of spending from a percentage standpoint, or really only focuses on 20 years and in. And as I mentioned, the healthcare system, it really does play into both of these potential risks. One, it's people are living longer because the healthcare continues to improve, but that adds obviously to the amount of time they spend in retirement. And then the inflation potential, healthcare costs could go up. I know there's obviously a lot of politics that goes into that, but really the expectation is definitely that it's going to go up. And even if healthcare inflation doesn't necessarily creep in, we think kind of the artificially low inflation we've had now for a good amount of time could potentially go up. So it really is a risk. A risk doesn't necessarily mean that it's going to happen, but it's just that it's something that a strategy has to be prepared for. So that really does set the stage for why there's so much opportunity out there when it comes to retirees and their income-generating portfolios they're looking for. But really the challenge that goes along with that, as people live longer, and there's a potential for increased inflation. Now, the current strategies that have been out there, I'm actually going to break it into two sections. There's going to be a couple of strategies we talk about here that really rely mostly on fixed income or bonds. And then I'm going to do a little bit on some of the newer asset classes that we as portfolio managers and advisors continue to begin to use really to add to that solution set. Again, the first more traditional set of strategies really do focus and rely on fixed income. They rely on bonds. And as we can see, just kind of generally speaking, bonds have been on quite a tear for, let's say, roughly 35, 40 years now. As we all know, in the late 70s and 80s, interest rates got fairly high as they tried to tackle inflation. But since then, bonds have really benefited from lowering of interest rates, which we can see here on slide 9. So you have to take those two slides in and really start to get a better understanding of why bond-based or fixed income-based strategies have become the predominant solution. I think rates have continued to drop. I know we all expected rates to rise the last year or so, and they really haven't. They've kind of held flat or actually gone down a little bit. But just within the last week or so, we've really started to see the Federal Reserve come out and hint very strongly that their expectation is that rates are going to rise. We can debate all day long kind of how quickly they're going to raise rates, or ultimately how high they may raise rates as this cycle starts or ends. But the fact is that we're probably not going to be in a 30-year plus rate decline that's going to promote strength in bonds. So the bottom line is with these particular strategies that you know, they rely again on a kind of a strong bond or a lowering of interest rates, and that's probably not going to be the case as we go forward. So some of the popular strategies that are out there really are linear glide path models. They normally take the form of something like a target date, something similar like or something simpler like age in bonds, which is basically a linear glide path that just moves 1% to bonds. So if somebody's 70 years old, they roughly have 70% of their allocation in fixed income. And then something more like a constant proportion model. Let's say somebody retires with 50% equity, 50% debt. They just hold that throughout the rest of their retirement. Think about those for a second. We're actually going to come back to those a little bit later when we compare those strategies, but those have been the predominant strategies that investors have used as they've entered into retirement the last, let's say, 15 to 20 years. So what's new? I think everybody understands that you know, the way we just framed the problem here is that you probably don't want to just rely on bonds going forward. Obviously everybody's been stretching or searching for yield. There's a variety of terms out there, but you know, people have been expanding essentially the asset classes that they've been looking at to try and generate that income. You know, if a client ultimately needs 4 or 5% of income, it's been very difficult to do with the kind of the typical bond market with treasuries. So people have been using a little bit more, let's say, emerging market debt, high yield, and more recently, you know, REITs and MLPs have become extremely popular. I know, particularly in our portfolios, you know, as we look for adding something to our income models, you know, we've used REITs, we've used preferreds, we've used MLPs in particular. We've used the IYR. It's an iShares REIT ETF. We have used the AMLP, which is the Alerian MLP ETF. All of those have been great options for us, and they've continued to do well, especially as rates, you know, were declining the last several years. But we, as professional managers, kind of understand that there's risk inherent with those particular asset classes. And one of the things I don't see when I do go out to conferences and kind of look around at the various booths that are out there is there are plenty of REITs, there are plenty of MLPs and some other solutions out there. And when you look at the material, it doesn't necessarily focus on what the risks are. Everybody's just focused on what the yield is or what type of income they can draw from that. So one of the things we wanted to do internally here is really do a little bit of research and really get a sense for how risky those asset classes were. In particular, we wanted to focus on the kind of the two predominant ones of MLPs and REITs. And what you're seeing here on this slide is kind of the traditional stocks and bonds. So we're using the S&P and the AG as proxies for those, but or excuse me, the Barclays Aggregate Bond Index is what we're using, or in this case, the AGG iShares you know, ETF. And then we're comparing the REITs and MLP ETFs we just mentioned. And on the left, you know, it's not necessarily as important what one of the specific pieces of these slides are, but one of the things you need to know is or one of the main takeaways is that you can see that the light line there on the left and the blue line on the right is essentially as volatile, if not more volatile, than just general stock market is throughout time. And bonds, which is the orange line, remains the least volatile of the asset classes overall. Now, if you went in and Ali, you know, will probably have some questions, but he didn't mention before the call that, you know, the stress on duration is kind of an issue. So if you're going out and stretching for yield and you're really going out the curve and you're trying to get 2.5%, 3% in a 30-year, that might come back to bite you a little bit when rates start to rise, because that end of the curve, the long end, is very sensitive to rates. And again, you know, most people are not going to want to sit in a 30-year bond that's paying 2.5%. They may get it back. It'll mature to par. You'll get your 2.5%. But if inflation goes north of 2.5%, all of a sudden you're making a negative real yield. So, you know, none of those things are particularly attractive. And just to put a finer point on it, when you're really looking at these as asset classes, you know, bonds continue to be, you know, the better diversifier with the lowest amount of drawdown overall. And then second in line really is the broad stock market. And one of the things that I think is surprising that you don't hear much out of the industry is really how much risk there is in the REIT and MLP market. I think the REITs seem to make sense. I think with 2008 and kind of what happened in the real estate market, I think people believe that a little bit more. In fact, it dropped a little over 70%, you know, from peak to trough. MLPs, though, I think most people think are a little bit less risky, In fact, they have roughly the same amount of risk as the broad stock market. So just putting a finer point on understanding what risk you're really taking on when you're getting that extra 1 to 2% of yield, I think is important, because they do have their place as you build your income strategies and you broaden out to multiple assets just away from bonds. But you have to know also kind of when to take some of that risk off. And we're going to get into a little bit more about what other solutions we see going forward. But then again, you can use these. You can definitely use these asset classes as you try and expand and try and increase yield in your portfolio. But as we mentioned earlier, there really is no free lunch. If you're getting yield, if you're getting return, it comes with risk. Okay, so MLPs, REITs, other non-traditional income sources, you are going to get more yield. They do have a place in a portfolio. They tend to work more as diversifiers or positions you're going to want to have on. But as interest rates begin to rise, just need to know that there's more risk there, and you need to be careful.
Kevin, Ollie here. Sorry to jump in here. We've had a couple of questions pop up, and I think you're laying a lot of information out there. And so let's just take a quick breath here. This is a very basic question, but I think it kind of focuses on what really matters here. With regards to MLPs, can you take a moment just to define what it is? Why is it that it's a high yield investment? How does it fit into this whole scheme? It's a very basic building block kind of question. So if you can indulge this one question, that would be great, just to kind of slow this down and allow us to take in what you're saying, please.
Yeah, no problem. Absolutely, Ollie. I think MLPs basically stands for Master Limited Partnerships. And it's basically an investment structure that's normally focused, about 90% of them really are focused either in natural resources or energy, which is kind of the same thing, really. And we're going to just use an example of something where, let's say you have an oil well, and let's say you're getting an ownership stake in that oil well, and in a particular case of an MLP, let's say it's paying a 5% dividend or a 5% yield. Now, the oil well may be producing well above that, but that's essentially what the MLP or the legal structure is going to pay you out at 5%. Now, when people look at it and say, wait a minute, so I'm owning a piece of, let's say, an individual oil well. Now, in most cases, they are going to be they can be diversified, so they'll have multiple natural resources, multiple wells. But I think for simplification, it does make sense just to say, all right, I own a piece of an oil well that's producing oil, and as long as oil's high and energy is doing well and there's demand for the product, no big deal. It's very easy for that MLP to pay off its 5% yield. Now, what happens ultimately if the oil well dries up, or in the most recent case where the price of oil drops to where there's a potential oversupply that there's been, and all of a sudden the price of oil drops, and now there really is the potential for that oil well essentially to be shut down, let's say. And all of a sudden you can't pay that yield. So I'm somewhat oversimplifying, but really an MLP is just a legal structure that wraps around some sort of normally natural resource product that's producing revenue. And instead of you taking a full equity ownership in that structure, you actually get paid off a percentage via yield. So when I think of it as kind of a portfolio, it really is a very focused portfolio that does spin off something like a yield or a dividend.
Right. There's also a question about REITs that came up. Are we talking about listed REITs or non-listed REITs when you talk about this as a part of the yield strategy?
Yeah, so
getting income?
That's a good question. I'm trying to use the most broad, kind of the oldest indexes that are out there. And in the MLP land, it's the Alerian MLP index. In the REIT world, I tend to use the Dow Jones U.S. REIT index, and that's also what the IYR or the iShares. I believe that's what the iShares REIT ETF tracks. So it's going to be the Dow Jones REIT index, and that's a good question. I believe it's all listed REITs, or I'm not sure if it's always been that, though. Okay.
Thanks. There's one more before you push onward here. I believe it's slide 19. Can you move the deck back, please? I think slide 19 is a question about the time period of that chart.
Okay.
We have to slip back, 4 slides? We're on 23. Give us a moment here. Yeah, there we are. I think there was a time period on. Yeah, that do you have the slice of time where that's being conveyed? That's not immediately clear there.
Yeah, so I believe this is as of the end of the year when we're looking at just what the yield was at that time. Yeah, so this is a snapshot of what the yield would be at that time. Yeah.
Okay,
So
perfect. Thank you. Appreciate that.
Mm-hmm. Yeah, no problem. Okay, let's see where we were. Yeah, so just to kind of give a quick recap. Thanks. I mean, obviously, any other questions, I'll just jump in. But it's a good time to kind of recap and say, look, we're not saying to throw the baby out with the bathwater so far. We're just saying that there's a great opportunity as people retire, but there's also some great challenges in front of them because basically the environment they've had when it comes to fixed income investing is most likely going to be a little bit different. And the current solutions that the marketplace has brought forward as pure yield investments like an MLP and REIT do come with some added risks because they do ultimately sit on top of a specific set of securities that are focused in a sector normally. So, you know, the idea is that there's probably another opportunity out there. And I think we want to talk about what it looks like to essentially, you know, solve the problem by having a more balanced portfolio. So we're talking about kind of the name of this slide here is equity-based strategies. And I'm not saying, and we're not saying that, you know, you should run out and basically sell all your fixed income. You know, I understand, you know, when I speak to family members that are retired, they have no real interest in going out and putting all of their retirement dollars into the S&P 500, and that's not what we're sitting here talking about. What we're saying is that as you retire, as people live longer, as there's a potential for inflation, having a more balanced portfolio is probably going to be a better way to solve and meet some of those challenges. And quite frankly, we're not the only ones saying that, and I think that's why it's very topical to have these discussions. I know that's why ETF.com is doing it. Is to really say what else is out there, how are other people solving this problem, because as people live longer, they need to continue to generate income. Now, the kind of the dichotomy here is that you know, people have saved a certain amount of money, they have liquid assets. They do understand, they tend to nod their head, I'll say, when you go out and you say your money that you've saved needs to work for you. And people understand that concept, that money needs to do something, it needs to grow. But when you say, hey, you need to put some of that principal at risk so that it can fluctuate, there's going to be some volatility with that, there's a tremendous amount of pushback. And I know we had talked about this a little bit, and I know we talked about it a good bit here in the office, but we really think that the takeaway really from these presentations is less about, you know, our particular solution, but it's as much about the idea that the average retiree, again, the ones that don't have $5 million or can live off interest only, they're going to have to get a little bit more comfortable with putting some of their principal at risk, having it in something like an equity strategy, or having some equity in their strategy, more to the point, so that money that they've saved can continue to grow, and then they can generate income by using something, you know, more of an income sweep versus just living off the coupon payments from fixed income or the dividend payment from something like a REIT. So as we kind of lay that out here, you know,
Kevin, before you push on, one more question. As we compare what you're going to lay out here in the coming minutes to what was, I mean, what's a useful benchmark to measure what you're proposing here versus history? Are we talking about the Barclays aggregate as a reference point to compare what it did in the past and what it may do in the future relative to what you're talking with your multi-income strategy? How do we think about this in a very clear way to set up the comparison so we can understand what we're trying to achieve and how we're doing as we set out to achieve that objective? Is that making sense?
Yeah, no, Ali, that's a great question. It's probably still one of the open questions really in our industry because, you know, what we're talking about here in retirement specifically, it's not a perpetual problem. It's not the accumulation problem. It really is a goals-based or you know, a very individual problem that we're talking about. So the idea is less about am I keeping up with the markets? It's more, is my working capital replenishing the amount of spending I'm doing on, let's say, an annual basis? So just to make it very simple, if I'm spending 5%, was I able to spend 5% and then over time am I able to grow back so that I can continue to spend 5%? Or did I have a poor year in the market or a great year in the market, in which cases I can either up my spending or my longevity may have just been projected to go out further. So there isn't a great benchmark out there. We have seen, you know, Morningstar's put some retirement income benchmarks that I think have been interesting. But generally speaking, what ends up happening is you do something where you take just a broadly diversified set of indices or something that would be a benchmark for a broadly diversified portfolio. And that's about as good as anything when it comes to how is the working, kind of how is your portfolio performing. But really this is more, I think one of the benefits of looking at it as a strategy this way is you're sitting down and it really can be catered to the individual investor and what their needs are. Because as we all know, that probably more than any other phase of life, when you're in retirement, circumstances change. So whether it's health, whether it's other issues pop up or other benefits pop up, I think that the idea of benchmarking is less around something like an S&P or an ag or a blend of those, and more about sitting down with your client and making sure that their goals are being met on an annual basis or that they're ahead of schedule. Okay?
Thanks.
Yep. All right, so we've titled the slide and really kind of want to go forward here. We're really talking about the search for income, right? It's not stretching. You're not just looking for yield. You really need to think a little bit more broadly, or we've thought a little bit more broadly about the solution. And again, it really is about taking that money that's been saved and making sure it really works, for the retiree on a go-forward basis. You have to address all of these things, in our opinion, to have a successful strategy. You need to address, shortfall risk. We've mentioned it as longevity, but it needs to have the ability to mitigate some of the volatility for a variety of reasons, which we'll talk about. Interest rates and inflation, those are tied together. We've already shown kind of where interest rates have been. I think that's fairly well known out there. Inflation's been relatively low and continues to be low, but that may not always be the case, especially when you're looking at 20-plus years. And liquidity. I think there's a need for liquidity. As I just mentioned, the situation tends to change, or events tend to pop up a little bit more in retirement than maybe some other phases of life. So the need for liquidity is extremely important. If you need to get to your money, it's important that the strategy tries to address that. So again, this is kind of the way we framed the problem for us before trying to find somewhat of a solution or a strategy to tackle it. So the secondary question is kind of what we titled this, is can a solution that basically includes more equities be helpful for generating income for longer periods of time? That's the question. Hopefully this research and we, we're trying to kind of raise that issue again here with the advisor and investor community. The first kind of the solution, or what we consider to be a complete portfolio solution, really does start with the investment portfolio. So the retiree now has accumulated some wealth. We think, a solution that's going to be successful needs to continue to take advantage of the opportunity set that's out there. So as Josh mentioned, we're a global flexible manager. Well, simply what that means to a retiree is that, the investment portion of their portfolio is not necessarily just going to be in the S&P 500. There's so many other opportunities out there, and I know we want to talk a little bit about some of the things that we currently hold in our portfolio, but I think it's those are fairly representative. Right now we have a Wisdom Tree, equity, European equity hedge portfolio that basically didn't exist a decade ago. We're able to take advantage of the strength of the dollar and the potential turnaround here in Europe from an economic standpoint, and have that all within the investment portion of a retirement strategy. Other things we've also owned, again, that kind of highlight locally. We have a First Trust Healthcare, I believe that's FXH. That particular ETF again gives us very specific access to the biotech and pharma, subsectors in the U.S. And I think in a place where, at least so far year to date, the U.S. has struggled to perform relative to some other, foreign equities markets and some other asset classes, there are some pretty bright spots that we as kind of a global flexible manager have been able to take advantage of and really have to continue to be a vital piece, really, of an income-generating solution here. But there's a couple other things you need as you really transition into in our case, or what we think to be a kind of a better strategy for income generation, and that's you want to have a spending reserve. It tends to lower the overall risk of the portfolio. When we talk about a spending reserve, we're talking about, in our case, something like 3 years worth of short-term liquid assets. We mentioned having liquidity for events. But one thing we haven't mentioned is kind of the better investor behavior, that having a very liquid, significant, in our case, a 3 years, let's say, amount of money that can be up to 20% of the portfolio in something where the retiree can use it immediately. So if an event pops up or they have an opportunity they need to take advantage of, they can use that money, and it's not going to be invested, let's say, in the market or in fixed income where there's a potential penalty for selling those assets. So having that spending reserve there promotes the better investor behavior, decreases the total amount of risk within the portfolio, and then kind of as we've said, it really helps them focus on less about the volatility of the market or the underlying portfolio and more about, okay, I'm very comfortable that that's where my spending is going to come from. So as we mentioned, there's more sensitivity towards principal volatility once you get into retirement. So that's one of the things that we've added to the this particular strategy.
Kevin, when you talk about that 3-year short-term liquid asset spending reserve from an ETF-specific point of view, what are you talking about? Like iShares SHV or Mint from PIMCO? What are you talking about? I presume you're making references indirectly to potential ETF holdings there in that 20% that you talked about, right?
Yeah, absolutely. Like you're talking about things like SHY or Bill, things that are on the 1 year and less liquid treasury instruments. Mint is another one that's fairly new. So you definitely can use ETFs, and us as ETF managers, we prefer to do that. You don't just want to hold cash or necessarily a money market. There is some benefit to having or using, let's say, that spending reserve, especially with interest rates kind of moving around. There is a little bit of value to be had there, and those are the types of ETF instruments we continue to use there. So yeah, it's a good point. Okay. All right, so once you have kind of the spending reserve, we're not going to get too much into the strategy. I just want everybody to understand that having a balanced portfolio that does include more equities, let's say, than the traditional agent bonds or linear glide path approach that we mentioned earlier, is going to be important for preserving kind of that capital that's been accumulated, potentially growing it and allowing there to be an increased longevity of spend. But we won't know that until we kind of test out this strategy. So the one other piece of this strategy is from the spending reserve on a quarterly basis, let's say the client is taking a 5% annual distribution, so he's taking 1 1/4 out. He's using that to pay his bills, enjoy his life. We need to figure out a way how to replenish that spending. And the only other nuance to the strategy, which is, again, kind of behavioral or counterintuitive, but behaviorally beneficial, is that you do not want to lock in gains when the market is down. So basically, if the investment portion of the portfolio is down, there's no money swept into the spending reserve. If the portfolio is up, we are going to replenish the spend. So it's as simple as that. It avoids locking in down markets and actually only replenishes when the markets have been positive. So we're just going to kind of take those components, spending reserve, investment portfolio, with the spending sweep, and kind of put that in the back of our head. Because again, this is more about, it's less about necessarily the sweep and more about just what happens when you balance out your portfolio. So we mentioned the bond strategies earlier. We've talked a little bit about what happens if you look at adding some, more of an equity-based investment, or in our case, the real spend strategy, which has spending reserve and investment portfolio with a sweep. We want to test a little bit of those strategies, which I think becomes a little bit more compelling. But before we do that, we're just going to highlight, we mentioned earlier that success is a little bit different when you get into retirement. So there tends to be 1, maybe 2 metrics that stand out, and I think the main one really is running out of money. I think the fear of running out of money is what drives most of the activity or the investor behavior in retirement. So we want to measure that as our primary measure, so what we call probability of success. So as we go forward here over the next couple slides, we're going to be doing some testing at different time frames, 20 years in retirement out to 30 years. What we're talking about here, or what we consider to be a successful simulation, is one in which the retiree does not run out of money. So he never has to move in with his kids. He never has to go live somewhere else. So that is success from what I understand from everybody that's retired. That is the primary goal. The second, and somewhat, some people would argue somewhat of a less primary goal, is how much money do they leave for their kids. I guess it depends on really how much they like their kids. But ultimately, legacy is a huge piece. I think, once you've kind of assured that you're not going to run out of money yourself, most people would love to leave a little bit of money in legacy or estate wealth to the next generation. So those are going to be the two main measures of success when we look at some of the testing we've got going forward here. Just to highlight for everybody, we're using data from 1926. It's Ibbotson data. We're using stocks and bonds. The S&P and the bond is intermediate term bond, so it doesn't have a ton of duration risk, but it's also not too short. An interesting thing, or one of the real things to highlight here, is that we're not just looking at 20 years. I mentioned earlier that a significant amount of the testing that goes into income testing is done at 20 years, and you'll see why here in a minute. We think people are going to live longer than that, or would like to live longer than that, so we're going to test at 25 and 30 years as well. We're also going to test at 6 and 7% spend, not just at 5 or less, and we'll see why we think that's important. Unfortunately, most people think they only spend 4 or 5%, and they tend to find that at least at some point they need to spend higher than that. So it is important to know kind of what happens with each of these strategies. And the last thing is inflation adjustment. So I kind of left it to the end, but there's a lot of retirement research out there, and most of it's done in nominal terms. So anything that's done in nominal terms is only tackling half the problem. So we mentioned earlier, inflation risk is huge, especially we expect it to be even bigger going forward. So if the results here really aren't done in real terms, then you kind of need to take the results with a grain of salt, or at least kind of figure out what it is in real terms. Okay. So with those metrics in mind, that's a little bit interesting. There's a couple of things we were going to look at. We were going to look at success rate by spending rate, but it's unfortunate. I believe the graph looks a little bit dark. So what I'm going to actually do is I think I'll just highlight some of the findings we had. There's actually two different things that we were going to be looking at here from a metric standpoint. And again, we said probability of success is one metric. The second one is legacy wealth, and the other variable, in this case the x-axis we were going to look at, was spending rate and the amount of time spent in that retirement. And so at from a spending standpoint, the biggest conclusion we'd be able to take away from this, and like I said, it's probably going to be easiest if everybody kind of gets the research summary as a follow-up to this, because it really does highlight these points. But there's a reason why people do the studies at 20 years, and normally you have the kind of the golden 4% spend rule, and that's because most strategies work at a 4% rate. There's a tendency for both bonds and equities over long periods of time to outperform that 4% number. The issue really pops up when you get out into the 5, 6, and 7% spend rate. So the piece does a better job of highlighting it, but ultimately having multi-asset, or what we talk about the constant proportion strategy, those do better than just the bond-focused strategies, but they don't do as well as the equity-based strategies. And that's because over longer periods of time, equities tend to hold up, they hold up better against inflation, but they also hold up against that higher spend rate, and allows you to replenish the bucket, or kind of that spending reserve, more effectively through time. The second piece is horizon. So, as people retire, there's kind of a precipitous drop-off when you get out. And I think I can use this slide. I know it's a little bit difficult, but essentially what we're looking at here is there's going to be, it's going to go from 20 years on the left out to 30 years on the right. And, yeah, there it is. So the amount of money, the amount of both legacy wealth and success rate go up significantly once you pass the 20-year mark, when you have at least a constant proportion to equities, or an equity-like strategy like the real spend that has a logic built into it. And more importantly, the difference between the constant proportion and equity-based strategies versus the bond-only strategies actually grows in size the further out you go. So just to recap, we're just going to recap the research here. Any strategy that ultimately is going to rely on bonds is going to be challenged, in our opinion, going forward. So at a minimum, adding other investment vehicles like we've added, like we talked about a little bit about MLPs and REITs, as long as you as long as you understand when to use and in what sizes to use, we think that expands not only the kind of the diversification of the portfolio, but obviously the yield and the kind of the income generation piece of that. But again, that's probably not going to be the only solution because of that risk that we showed earlier. We don't think investors, and in particular retirees, are going to be comfortable with the amount of volatility that those asset classes generate. So on a go-forward basis, those aren't going to be, those cannot be the majority of your portfolio. So in our case, what we're saying, and I think really what the industry is going to be grappling with going forward, is how do you convince the retiree to put their saved assets at risk and allow there to be some volatility, but more importantly, some growth in those portfolios, so that they can continue to spend past, hopefully past the 20-year mark, and at higher levels than at the 4% rate, which I think those are far too low a hurdles, given where we are as people retire and as they live longer and as they're looking to spend more and maintain kind of their standard of living. So with that, I'm going to kind of wrap it up, and I'm going to turn it back over to Ali. I guess if there's questions, we can field some questions here. If not, I'm going to turn it back over to Josh.
There are a few questions, Josh. If you wanted to jump in, that's fine. But did you want to? Were you going to do concluding remarks, or do you want to add to what Kevin was saying? Because there are certainly a few questions here we can get right into. You tell me what you want to do there.
Let's go right to the questions, Ali. I just want to make a couple comments as we close. Yeah.
Okay, that's great. All right. So with that in mind, Kevin and Josh, then I'll get right into the questions. There's questions about how do you come up with that spend rate. You talked a little bit about some different numbers. How do you size the spending reserve is really the precise question that came in. I wonder if you can go back there, Kevin, a little bit and develop that idea. It's obviously a crucial one.
Yeah, and in that, let me get back to that slide here. Yeah, that's a great question. I think the honest answer is it came to us through doing testing, through all the simulation, and the reality is that the markets have generally not been down more than 2 years in a row on a kind of a quarterly basis. So 8 quarters is kind of the longest that the market has struggled. So that means having at least that amount was necessary to maintain the spending reserve. So adding a third year of buffer, 4 is too much. It's way too much to have in short-term liquid instruments, but you needed to have more than 2. And through the testing, it may have been something closer to 2.7, 2.8 years, but it just made sense to have it at 3 years because you never know. There may be something in our future where the markets continue to go down for extended periods of time. But 3 years tended to make sense. It's a great balancing point between having enough in spending reserves to where the investor, or in this case the retiree, is comfortable spending out of that reserve, but also gives the investment portion enough time to fill it back up. So it balances both of those things out well.
Okay. Now there's a very broad question here that's come in. Is the equity-based strategy better than the multi-asset strategy? Help us frame that decision-making process, because it's probably not the same answer for everybody, right?
Yeah, better is a tough one. I mean, I think the way we laid out what success was for this test was all about, again, not spending all of your starting capital at the end of the time period, whether it was 20, 25, or 30 years, and then also how much money there was left over. I think, the multi-asset, or basically, I'm going to go back to that slide that you mentioned earlier, 19, to look at the various asset classes. There are kind of different issues with each one of the asset classes. So, if a client has been extremely successful and done a great job in saving, and they have a low amount of expense, so let's say they can spend 2 to 4% to maintain their standard of living, then you don't necessarily need to really broaden out and have a more balanced portfolio that has a significant amount of equities in it. It makes a ton of sense to use safe assets. And only take on a certain amount of risk in terms of stretching for yield. Again, those clients have a variety of options. This, in terms of what's better, I'm not going to say best or what's the best, because like you said, it really comes down to the particular client situation. But we think a good option, or at least a fourth option, if you consider the main options to be bond-based strategies, MLPs and REITs. I'll throw annuities in there. If you consider to be kind of the income-generating strategy that has a more balanced or more equity-like investment portion, then I think it makes a ton of sense for people that are on that borderline. They may have not saved enough, or they need to spend above, let's say, 4% for a decent amount of time. You're going to have some volatility ultimately in that portfolio just to keep up with inflation when it does come back, and also to grow that wealth so that those people can spend. So, I would say that the highest net worth, you can go multi-asset and be very safe, but for everybody else, you're going to need to kind of broaden out and include some equities.
Now, I'm glad you went back to slide 19 there. There was a point of clarification that came in with regards to the time period, the question I asked you earlier. It was actually a reference to the maximum drawdown bar chart and what was the time period on that chart. I can't remember the number, unfortunately, off the top of my head, but that's the time period there was, again, the drawdown chart.
That was from 2003 till the end of February.
Of 2015?
Yep, 2015. Mm-hmm.
Okay, perfect. Okay. Now, there are a whole bunch of questions. People want to leverage your ETF knowledge here clearly to be very ticker specific, and I've certainly mentioned a few. We talked about the short-dated things like BIL and SHY. Now, on the equity side, too, when you talk about your equity income replacement strategy, can you mention some tickers? I know you made a brief reference to the Wisdom Tree Hedged European Fund, HEDJ. You talked about the Biotech and Pharma ETF from First Trust, FXH. Can you talk about this equity strategy in a very ticker-specific context, please?
Yeah, sure. And frankly, we do run this across a variety of platforms, so it can take a couple of different shapes. On one hand, we do run it where we have less turnover, and we actually use some of the PowerShares large cap value and large cap growth, or AlphaDex, PowerShares ETFs there. Let me get you a couple of tickers real quick.
AlphaDex would be First Trust rather than PowerShares. Thank you. Slip of tongue there, I believe, unless you did mean PowerShares, in fact.
Yeah, and we were just talking about the First Trust AlphaDex. We use, I did mention that on the healthcare side. Let's see. So we use, like you said, we do use a variety of them kind of going across. So PowerShares large cap value we've used as a core, along with the large cap growth. We've used the First Trust, mostly on the AlphaDex on the sector side. So thank you for clarifying there. Most recently, I think on the we've used some Deutsche Bank names, and we've used the Wisdom Tree, HEDJ, DXJ. Those are going to give us exposure to the currency hedge versions of Europe and Japan in particular. We've used we currently have a position specifically in the iShares MSCI India, so INDA. And then, of course, a very large exposure is still going to be, given where relative or kind of where performance has been in the U.S., we have very large positions just in the SPY, and that just being, kind of solid S&P 500 exposure. We all know, I think everybody on the phone is probably very sensitive to how strong the S&P has been. I think that's been kind of a core holding. I think there's times when advisors look for managers like us to get extremely creative, but there's times when you just don't need to be. I think having large cap domestic exposure makes a ton of sense, especially in a liquid instrument like that, where when we do see the opportunities like within FXH, or right now we also have XLY, which is going to be consumer discretionary. It's a SPDR's sector that continues to do very well. Again, on the international side, it's normally been currency hedged, but we also have EWJ right now. We think that some of that yen move, where we were currency hedged in the DXJ, the Wisdom Tree, we've actually pulled that off. We think the yen is going to be stable now for a little bit, so we're back in the iShares MSCI Japan. So, in terms of, what symbols, we're fairly agnostic when it comes. We like to use the best solution depending on what the opportunity is. So hopefully that gives you a little bit of a flavor, and I think that's one of the important things. Let's bring it back to income, is having that flexibility within the investment portfolio. In particular, I've mentioned a bunch of international names. If you're looking forward, We think there may be some headwinds. Obviously, interest rates are looking to rise here in the U.S. That means you're going to need to have some significant international exposure if you want to continue to grow that investment piece of the portfolio, whether you're in retirement or not. So, it's amazing.
Well, one of the things that you talked about. Oh, go ahead. I'm sorry.
I was going to say, it's just amazing the quality that the issuers have come out with and the variety. It really is great for people like us to be able to use ETFs for solutions like this.
Now, you talked about DXJ and HEDJ, the two currency hedge strategies. DXJ focused on Japan, HEDJ focused on Europe. Both of those securities also tilt toward higher paying dividends, right, or more steady dividends. And I'm wondering, that's certainly relevant to your search for income, right? If you got an indexing methodology that's going to find more reliable income streams. Does it worry you at all that a lot of people are piling into these dividend-related strategies, and maybe they'll get into what I call factor fatigue? Everybody piling into the same trade makes it less sensible. You guys think about that at all as you look forward here to the coming years? How to find the best dividend-paying fund, basically, right? Is really my question.
Yeah, no, I think there will be some increased, interest rate sensitivity based on the fact that, it is the stretch for yield that got them into some of the dividend-paying stuff. But normally the beauty of dividend is that it's large cap. So it's going to be less sensitive than let's say, some of the other factor-driven exposures, whether it's high beta or small cap. Those tend to kind of, when they do crack or when they do revert, to the downside, they tend to be a little bit stronger than, let's say, something with dividends because of just the nature of the underlying stocks. So, yeah, there's been a lot of money piling into the dividend names, but luckily those are probably the best names to handle that amount of volume.
Okay, we are kind of on the edge of the hour. Josh, you want to step in and make your comments? We certainly left some questions on the table, but as I said at the beginning, there's nothing stopping you from getting those questions answered after the fact. And Josh, step right in there before I sign off, please.
Thanks, Ali, and absolutely we're available to answer any of the questions you have. I think that you can see on the slide our contact information, 866-371-2399 is our direct line. You can ask for me, Josh Bartholomew. I'll be happy to help you any way I can. As I mentioned at the outset, www.horizoninvestments.com, there are a multitude of tools on that website. You can sign up for a username and password there. The spending calculator does a fantastic job of giving you a very quick analysis of any type of client that you might have and how the spending strategy might interact with them and what the probabilities of success might be, what the legacy assets will be, how inflation affects their accounts. All of those things are available online, but we'd be happy to help you any way we can. We are also going to, as a follow-up, send out a research paper that we have on the real spend strategy, which will give you a lot of details about the solution that Kevin was alluding to and really the research that's gone into that solution. It's been around a long time, and so we're very happy to share that information with you. We'll be sending that out as a follow-up to this call. We pride ourselves, as I mentioned at the outset, on providing solutions to investment advisors and their clients on accumulation products through the gain life cycle. Those people that are approaching retirement, we pride ourselves on providing solutions for protection against catastrophic loss. And in this case, as a part of this webinar series, which we're proud to be a part of, we provide solutions for people that are in the distribution phase of their investment life cycle. And so we're happy to share those ideas with you and find a way to partner with you, really to help clients handle for longevity, which in turn helps our RIA clients, our investment advisory clients, help in solving the longevity solution for their practices. So please feel free to reach out to us again, 866-371-2399. And Ali, thanks so much for including us. We're grateful to be a part of it.
Thank you, gentlemen. That's all the time we have for today's webinar, Building a Multi-Asset Income Portfolio with ETFs. Thanks to everybody for attending. And a reminder, we have 4 more webinars this week. We'll get into dividends tomorrow with Wisdom Tree, share buybacks on Wednesday, and how to get more yield from traditional bond portfolios on Thursday, and then the final one on Friday, we'll look under the hood at the highest yielding ETFs out there. Josh and Kevin, thanks again for being here, and thanks to the audience for attending, and thanks for the great questions. You can get them answered after the fact, as we've said. On that note, on behalf of all my guests here and all my colleagues at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.